You might not realize this, but a massive economic storm is coming and you need to be prepared. Billionaires, CEOs, hedge fund managers, and venture capitalists are already getting ready and preparing for one of the biggest crises in history. We are already in a recession, but not many have realized it yet. In this video, we take a look at the strategy adopted by billionaires and the hedge fund managers to overcome the upcoming downturn. Stay tuned and watch. Most people agree that the market isn't predictable and you can never time the market to your advantage. While this is true, you can protect yourself from the forthcoming market crash or downturn. Billionaires frequently use tactics to hedge themselves against upcoming crisis. Billionaires hedge their wealth to protect themselves, and in doing so, they are the only ones with their heads above the water during a crisis. Take Elon Musk, for example. Elon already believes we are in a recession that could last for 12 to 18 months. And no, he isn't trying to time the market with his stock holdings. Instead of looking at the certainty of a forthcoming crisis, he looks at the future as a probability. Economic landscapes are fluid, and you should never be binary as to whether a crash will occur or not. Rather than going all in on his economic predictions that could be wrong, he is simply hedging his wealth for the worst outcome. Elon's latest decisions can be seen in him laying off 10% of salaried Tesla employees in preparation for a macroeconomic disaster. Now the reason why Elon is laying off so many employees is for capital preservation. Elon knows cash flow is king during recessions, and he's preparing himself before the recession comes and bites him. This strategy also applies to retail investors like you. The Federal Reserve has overextended its balance sheet by over $5 trillion. It plans to reduce money supply over the next couple of years. This means the Fed does not have the leeway to hand out free money like during the pandemic. If the economy crashes in the coming months, money will become scarcer even if inflation remains elevated. Elon already experienced the scarcity of money during the dot-com bubble, and he highly advises businesses to get their hands on cash while they can. Now, it's not only Elon laying off employees. Peloton fired 20% of its employees, Carvana cut 12% of its workforce, which totals 2,500 employees, Coinbase paused the hiring of new employees with new job offers and laid off 18% of its workforce. All of these companies laying off staff have just one thing in common: macroeconomic concerns. In fact, Coinbase stated current market conditions as one of the primary reasons for its layoffs. An article on their website written by the chief people officer explained how adapting quickly and acting now will help us to successfully navigate this macroeconomic environment and emerge even stronger, enabling further healthy growth in innovation. While businesses need cash flow to survive, so do you as an individual. Think of your monetary inflows and outflows as a business income flowing in and expenses flowing out. By subtracting expenses from your income, you can calculate your operating cash flow. Now take that operating cash flow and take your taxes to get your net cash flow. Although your operating cash flows are positive right now, it could disappear in the coming months. And it is for this reason we need to focus on capital preservation. There are a vast array of methods to hedge your portfolio against economic downturns. One of the most common methods is simply short the market. Carl Icahn manages over $21 billion as an investor. Lately, he is shorting the market. Icahn is known for being a corporate raiser. This means that he frequently takes over companies and sells them for profit by stripping the companies off their assets. Even though he is disliked by a lot of people for his strategy, he is one of the most iconic investors. He averaged an annual return of over 21% from 1968 to 2014. This is considerably higher than even Warren Buffett's returns. Icahn recently went on CNBC in early 2022 to describe why he believes there could be a recession or depression coming soon. He uses a volatile strategy. This means he has to hedge his portfolio against considerable downturn. Carl Icahn has been purchasing credit default swaps and mortgages of corporate offices and shopping malls. Purchasing credit default swaps is equivalent to shorting on steroids. By purchasing credit default swaps on corporate offices and shopping mall mortgages, Icahn is essentially shorting physical stores. This acts as a hedge against his possessions. Now, hedging doesn't mean you're timing the market. You're simply protecting your portfolio for the worst outcome. Another billionaire hedge fund manager, Liam Cooperman, is implementing a similar strategy. He made a return of 12.4% from 1991 to 2018, which is more than 3% of the S&P's average return. Similar to Icahn, Cooperman foresees a recession and is currently 68% net long. What this means is that 68% of his portfolio is long on stock and the remaining 32% is shorting the market. Although a lot of billionaires are hedging to short positions, many are not comfortable with the risk of shorting stocks. Cooperman has himself said that purchasing stock is a strong hedge against inflation. Before initiating his short position in April 2022, he actually called himself a full invested bear. This means that despite calling for a bear market, he had no short position whatsoever. So instead of shorting the market, he was just holding stocks in order to hedge against inflation. Another popular hedging method is to hold short-dated put option on your existing stock holdings. Cooperman has publicly stated that he has put options on Microsoft, Google, and Amazon despite having long positions in all three companies. This allows him to be protected against a short-run sell-off while still being well-positioned for the long term. His put options are a hedge against short-term downturns, while the stock holdings are for long-term gains. Some investors might think this strategy is pointless, but you have to put it in context of beta and alpha. Beta is the volatility of your portfolio in relation to the stock market. The S&P has a beta of 1. If you have a portfolio that is 2 times more volatile than the market, then that means your portfolio beta is 2. If your portfolio half as volatile as the S&P, your portfolio's beta is 0.5. Alpha is a risk-adjusted return that subtracts a factor of beta from your return. This means that it accounts for return for volatility. If your portfolio has higher volatility, your alpha goes down because you're subtracting beta. This also sorts on the other side. Lower volatility equates to higher alpha. A high alpha is what fund managers strive for because it adjusts the return for the risks that you are taking by having hedge bets against put options like long stock positions could be as reminiscing as alpha. Billionaire fund manager Chamath Palihapitiya is also preparing for a stock market crash. He believes that those who go for alpha instead of beta will be the only survivors of the upcoming downturn. Another fund manager named Jeffrey Gundlach recently launched a fund that aims to tackle the current and future economic issues. Gundlach manages over $140 billion through his mutual funds that have been consistently beaten their respective indices. Gundlach's newest fund is called the Double Line Chiller CAPE ETF. The CAPE ratio stands for the cyclically adjusted P to E ratio. This ratio essentially adjusts the P to E ratio for cyclical fluctuations and earnings. Gundlach is using the CAPE ETF to fund the most undervalued sectors in the market. The reason why Gundlach chose the CAPE ratio is because it divides the price of a stock by the company's 10-year average of inflation-adjusted earnings. This allows him to ignore short-term earnings fluctuations and effectively pick out the long-term winners. These long-term winners are those that have stood the test of time regarding the broader economy. The last hedging method is to simply diversify your portfolio. This is most commonly used by Ray Dalio, who is known as the king of hedge funds due to his focus on alpha. Through his allocation that includes almost every asset, he's protected in almost any macroeconomic environment. Billionaires use their own method to hedge their wealth, and we as retailers need to follow our own method to hedge our portfolio. Well guys, that's all for today's video. Hope you enjoyed this one. Thanks for watching.